All right, so we're living real time why interest rates matter so much. Interest rates have gone up dramatically. Well, we hear that a lot. What does that exactly mean? Well, think about a real world example. Interest rates have gone up 500 basis points, roughly a little bit more, in the last couple years. So that means that on every $1 million of loan outstanding, that's $50,000 more of interest. So $10 million, you multiply that by 10, 500,000 on $100 million. That's $5 million more of interest every year. So in the commercial lending world, that's what's going on. But even more importantly, from an underwriting perspective, so not only do you have to factor in that higher interest cost, but it's the trajectory of interest rates and where are they going. The reality is when you've been underwriting these loans for a long period of time, it was really interest rates are pretty static. They're at a lower level and they're going to stay there for a while, and that's how you could underwrite. That game's changed dramatically as well. I know the yield curve is inverted, and a lot of people are predicting that, oh, they're going to have to start lowering rates again at some point. Okay, but that's an opinion. That's not a certainty. And so when you're underwriting and the credit people inside of a bank or a finance company are looking at a request, they have to assume that interest rates are going to stay at a higher level or possibly even could go higher. And does this request still cash flow? Does the company and the borrower still able to service the principal and interest payments even if interest rates stay at an elevated level or even go higher? So those different scenario forecasts have to be done at a much more rigorous level and, frankly, at a more conservative level, given what's going on out there and the macroeconomic environment and everything else. So that's what's going on these days with loan requests.